We're going to continue our discussion on retirement plans with the individual sponsored retirement plan options. So the options for individual retirement accounts are the IRA and the Roth IRA. Contributions are limited to the smaller of $5,500 or 100% of compensation for 2018. And if an individual is 50 or older, the dollar limit is $6,500. Individuals that are covered under an employer plan, the deductible contribution amount begins to phase out when AGI reaches $101,000 if the taxpayers are married, or $63,000 for other filing statuses, and is completely phased out at $121,000 and $73,000 respectively. For married filing separately, the phase out starts at $0. So if you're filing as married filing separately, then you would not be able to take a deduction for an IRA. The taxpayer can still make non-deductible contributions up to the limits. For taxpayers that are married, if both of the individuals are employed and neither are covered under an employer plan, then both spouses can make a deductible IRA contribution up to the limits they qualify for. If only one spouse is employed and that person is not covered under an employer plan, then the taxpayers can contribute up to the maximum for both individuals. If one taxpayer is covered under an employer plan and the other is not, the non-covered spouse can contribute up to the dollar amounts as long as AGI is under $189,000. Roth IRA contributions are not deductible, but withdrawals are not taxable from Roth IRA accounts. The contribution limits are the same as with a traditional IRA, and the phase out for Roth IRAs start at $189,000 for married filing jointly, $120,000 for single or head of household, and again, $0 for married filing separately. The phase-out range is $10,000 for married filing jointly and $15,000 for others. So when looking at a traditional versus a Roth IRA, the contributions are deductible for the traditional IRA, but not for the Roth IRA. The distributions are taxable for traditional IRAs, but not for Roth IRAs. Taxpayers are trading off against the non-deductibility of contributions against the non-taxability of distributions with these two options. So let's take a look at an example. Ed and Kathy are both under age 50 and they file a joint return. Neither is covered under an employer pension plan. Ed earned compensation of $53,000 in 2018, and Kathy worked part-time and earned $1,200. What's the max that they can contribute to a deductible IRA during 2018? So they're both under 50, so their limits would be $5,500 each. So they could contribute $5,500 for both Ed and Kathy. So the next thing that we're going to take a look at are Coverdell Educational Savings Accounts. These are accounts that are set up to pay for higher educational expenses. The contributions are not deductible. However, the account does grow tax-free. Distributions are not taxable as long as they are used to pay for higher educational expenses. Any person can establish and fund a Coverdell Educational Savings Account for any person, including themselves. The contributions are limited to $2,000 per beneficiary from all sources combined. So if you have a Coverdell account for your child, and you also have grandparents or aunts and uncles also contributing to that for that child, even though they're separate accounts, the combined amount needs to total less than $2,000 for that specific beneficiary. Contributions for these accounts are phased out when AGI of the contributor reaches $190,000 for married filing jointly and $95,000 for others, and is totally phased out at $30,000 or $15,000 above those numbers. Qualified tuition plans are state-based plan for future educational costs. These are also known as 529 plans. These can be a prepaid plan for higher education, or they can also be an investment account similar to the college savings account that we just talked about. The earnings for these accounts grow tax-free and can be used for qualified educational expenses at qualified educational institutions. The expenses that are qualified are tuition and mandatory fees, required books, supplies, and equipment, computers and software, and room and board if the beneficiary is attending at least half-time. As part of the new tax code, new tax law, up to $10,000 per year can be used for tuition only at K through 12 schools. So if you're sending your child to a private school, you can deduct money from a 529 plan to help fund that. The non-qualified distributions of 529 plans are taxable and are also subject to a 10% penalty. A qualified tuition plan can be rolled over into the qualified tuition plan of another family member. So if you have a plan set up for each of your children, if your oldest one does not use all of the money, then that can be rolled down and used for another beneficiary. You are allowed to contribute to a Coverdell educational savings account and a qualified tuition plan the same year. And taxpayers can also claim educational credits or tuition and fees deductions and the qualified tuition plan withdrawal as long as the same amount of expenses are not used twice. So as long as your total educational costs are not less than your educational credits and the amount that is being withdrawn from your qualified tuition plan, then you're safe with the IRS for that. Distributions of these plans are generally taxable if the contributions were deductible. When some, but not all, contributions were made with previously taxed dollars, then the distributions will be partially tax-free and partially taxable. The simplified method for calculating this is to determine the number of anticipated payments using single life or dual life tables from the text, and to determine the total contributions from previously taxed dollars. So we're going to use the fraction previously taxed money divided by the number of payments, and this is going to represent the portion of each payment that will be tax-free. Other retirement plans have required minimum distributions. Roth IRA accounts are the exception to that. These distributions must begin by April 1st of the year following the year the taxpayer reaches age 70 and a half. And the required minimum distribution is based on the life expectancy tables from the IRS. And these tables will be used every year to determine what the distribution required is. Roth IRA distributions are generally not taxable. However, earnings are taxable if they're withdrawn prior to an initial 5-year holding period. So if you open a Roth IRA account and withdraw anything within that first 5 years, part of that's going to be taxable. With the Coverdell educational savings accounts, distributions are going to be tax-free as long as they're used to pay for qualified educational expenses of a beneficiary. And we can't, again, use the same expenses for a tax credit and for the educational savings account withdrawal. Premature distributions are going to be subject to a 10% penalty. However, there are some exceptions that apply to this. Rollovers are generally going to be tax-free. Rollovers to an Roth IRA from a non-Roth IRA are going to be taxable. If a rollover is distributed to the taxpayer, there is a 60-day window that taxpayer would have to deposit that money into a new plan. Otherwise, the whole amount is going to be considered a distribution and taxable to the taxpayer. So the best way to get around this is that any investment provider is going to offer a direct transfer rollover where your money will be directly transferred from one investment institution to another. So you don't actually have your hands on the money. So then you don't have to worry about that possibility of not meeting that 60-day window. So the last thing that we're going to talk about are annuities. An annuity is a series of payments that is pursuant to a contract. Normally, an annuity payment is going to be partially taxable and partially tax-free to the recipient. The tax-free component is based on the cost of the annuity contract and the expected return. The cost of the annuity contract is the amount that the recipient paid for that contract. The portion of the payment that is represented by the cost of the contract is free. So the taxpayer is going to receive the amount that they've invested as a return tax-free. However, amounts that are received on top of that initial investment are going to be taxed. The expected return is the total amount that the recipient anticipates receiving over the annuity contract. For contracts that will last a specified amount of time, the expected return is the periodic payment times number of payments. For contracts that will provide payments for life, the recipient must refer to the life expectancy tables from the IRS to determine the length of time.